Cash transactions are immediate and physical, making them incredibly difficult to trace once they change hands. In hospitality, that presents an immediate risk of loss. Cash is the most fungible asset in a hotel's ecosystem. A 20-pound note doesn't retain a record of who owned it last, leaving it highly vulnerable to shrinkage. But modern hotels face a very real operational paradox. They must secure this highly vulnerable asset without choking the liquidity required to make change and service guests on the floor. To solve that, we move into Lesson 2.4, Cash Management SOP Rollout for Petty Cash, Floats, and Bank Account Setup. Theoretical financial principles only work if they are translated into documented, daily standard operating procedures. Without strict daily routines, operational liquidity stops being a guest service tool and becomes an unmanageable financial liability. Controlling cash requires a rigid, top-down architecture that tracks the money from the institutional bank down to the cashier's till. At the top, we have the macro-level institutional bank accounts, secured and managed directly by the Director of Finance. The middle tier manages the front line. These are the operational floats used by department cashiers to conduct daily business. And at the bottom, we have the exception handling mechanism for unpredictable expenses, known as petty cash. When these three tiers operate together, they create an ecosystem where the location and purpose of every single dollar is strictly defined. The first step in this rollout starts at the top. The Director of Finance must secure specific institutional accounts. Mixing all hotel funds into a single account creates unacceptable exposure. A central node labeled Total Capital splits. The first split, the operating account, handles daily receipts with its balance fluctuating constantly. The second is the dedicated payroll account for employee compensation. Large organizations strictly require this dedicated account to simplify reconciliation and tighten security around sensitive employee data. Isolating payroll ensures a general accounting error or an unexpected vendor draw cannot impact staff wages. At the macro level, the DOF mitigates risk not by restricting the flow of money, but by strictly segregating its purpose. The third pathway leads to the tax deductions. The Director of Finance establishes a strict standard operating procedure to transfer these specific funds into the segregated account on a daily or weekly basis. This physical separation guarantees compliance. It ensures the hotel cannot accidentally spend government tax liabilities to cover internal operational expenses. With the institutional banking secured, control shifts down to the frontline operational departments. Front desk agents and bartenders need physical cash to function. We provide this through floats, predetermined amounts of cash assigned at the start of their shifts. Float size matches the department's exact change-making needs. A front office might require a 250-pound float, while a lobby bar might need 100 pounds. These floats exist solely to provide liquidity for making change. They are never to be used to pay for hotel expenses. To manage this, hotels enforce a rigid SOP for float assignment. Before a cashier takes possession of their till, they must complete a formal sign-out process. That physical signature mathematically links a specific stack of anonymous cash directly to one responsible employee. The float assignment SOP takes a highly fungible currency and locks it down as an individual trackable liability. The control established at the start of the shift is strictly audited at the end through daily reconciliation. The cashier must satisfy a strict mathematical equation. First, they return the original float amount. Second, they add all cash sales revenue. This total must perfectly match the physical cash in the till. Discrepancies trigger an immediate investigation. This formula creates a closed operational loop. It ensures that any internal theft or mathematical error is identified within hours. Even with strict budgets, a hotel will inevitably face minor, urgent, and unpredictable operational expenses, like buying emergency supplies. To handle this, hotels use petty cash, a separate fixed cash fund designated exclusively for these minor purchases. By placing petty cash under a designated custodian, like a chief accountant, the hotel ensures staff cannot raid change-making floats for emergency supplies. This exception fund is governed by a strict, non-negotiable accounting standard known as the impressed system. The impressed system requires the fund's total value remain permanently fixed. Cash only leaves if the custodian generates a signed, numbered voucher with a receipt. Periodically, the exact value of the missing cash is transferred from the operating account to replenish the fund. It is replenished only by the exact, precise amount proven by those accumulated vouchers. At any given moment, the physical cash remaining in the box, plus the total value of the vouchers, must perfectly equal the fixed fund amount. The impressed system removes trust from the equation. It demands mathematical proof for every penny dispersed. Looking at the entire system, we can see how this three-tiered architecture eliminates ambiguity in hotel cash management. The Director of Finance enforces institutional segregation to isolate tax liabilities and payroll. The cashier executes mathematical daily reconciliations to secure operational liquidity on the floor, and the strict voucher requirements of the petty cash impress system lock down exception spending. Through these procedures, the movement of a highly fungible asset becomes mathematically auditable at every single step, from the institutional bank down to the individual till. In modern hotel operations, documented, mathematically rigid controls are the absolute frontline of institutional financial security.